what's important to accountants and advisors to January 2024. Inside this month, are financial advice fees deductible? We'll also look at the ATO's clarification on the boundary between contractor and employee. That's more clarification there. But first up, a case from the AAT. Now, this is another interesting property case with another interesting outcome. Michael, what can you tell us about this case?
Yeah, there have been two recent cases that have come out of the AAT just over the last few months, and we looked at the first one of those, the Bauman case, back in the previous version of the tax roundup. The more recent case, the Lance case, looks at something which is, it's a different set of facts, but it's on a similar theme. And it's really about this issue of someone who's bought and sold property and whether the sale of that property is basically a private type of transaction, which might be on capital account and outside the scope of the GST system, or whether it is a business-like commercial transaction, which potentially pushes the taxpayer onto revenue account and then also increases the risk of falling within the scope of the GST system. Now, the Lance case focuses directly on the GST issue. The taxpayer bought a property. They had said that they had bought it for mainly private purposes, but over the course of about 7 years, there were some activities that were undertaken which ended up meaning that the property was sold for a profit 7 years later down the track. Now, those activities included rezoning the property. It was initially zoned as tourist. They had the property rezoned. There was an approval for a subdivision of the property with, it looked like some plans for further subdivision to occur later down the track. Now, that subdivision never actually occurred, but the plans were approved. There was a conditional approval. Some works were carried out, sewage, electrical, water, all those sorts of things, connections hooked up. The taxpayer borrowed a reasonable amount of money to help fund some of those activities. And so over the course of that 7 years, there were some things done to the property, not necessarily physically, but in the background. And that did lead to this property being sold at a profit. Now, the taxpayer didn't pay GST to the ATO on sale of that property. The taxpayer argued that this property was bought to be used for private purposes. The subdivision was going to occur for private purposes as well. The taxpayer said they planned to keep one lot for themselves as a private residence. They were going to gift a couple of lots to their children, again for private purposes, and they were going to keep one lot as a memorial for a family member. So the taxpayer had said that this was land that was only ever intended for private use. The fact that they were going to subdivide it, again, had a private purpose to it. It wasn't a commercial or business-like transaction. So they didn't pay GST to the ATO. Now, the ATO audited the taxpayer. The matter ended up before the AAT. The AAT has found for the ATO. The AAT found that despite the fact that the taxpayer claimed they had bought this property for private purposes, they also had another intention. And they had an intention of basically taking advantage of this property for commercial gain, and had done so in a business-like or commercial manner in order to make a profit. So the tribunal basically concluded that the acquisition, the sale, and what happened in the meantime had a commercial flavour to it that amounted to an enterprise for GST purposes. Even though it wasn't a business, it was still an enterprise, and that the sale was made in the course or furtherance of that enterprise and therefore should be subject to GST. Now, the taxpayer had also argued that, well, even if this was an enterprise, this should be an input tax sale of residential premises. Now, the problem here was the AAT found that even though there were some buildings on the property, they weren't capable of being used as residential accommodation. They weren't habitable. So the AAT said you couldn't therefore argue that this was an input tax sale of property. So in a nutshell, we have a taxpayer who thinks they're selling a property that they bought and used for private purposes only. The AAT saying the evidence doesn't back that up. This is a commercial transaction and should actually fall within the scope of the GST system.
So what should the profession be taking away from this?
Yeah, there are a few things to take out of this decision. Look, your client's facts might be different to this. Look, facts are always going to be a little bit different, but there are some principles and key things that we really should be just keeping an eye on here. The first one is around intention. Now, often when we're looking at property transactions, one of the things that we'll look at in determining whether a property sale is taxed on revenue or capital account or might be subject to GST is why did the client buy the property, and why were they developing it, why are they selling it. So we're looking often at intention, and intention can carry quite a lot of weight when it comes to determining the tax treatment. Now, what we often say when we're looking at this issue is intention is something that is determined with reference to objective facts. Intention is objective, not subjective. So what do the facts say? Now, this taxpayer said, I bought the property to be used for private purposes. It has no business or commercial flavour to it. The AAT said that's not what the evidence says. And the AAT found that there was some inconsistent evidence when you compare it to the taxpayer's statements. For example, there were some media reports relating to this property where it was suggested that the taxpayer was planning to commercialise the property. So that was obviously a little bit different to what they had told the AAT and the ATO. It turns out that during the objection process, the taxpayer had made some comments to the ATO suggesting that they needed to subdivide the land and sell some of the lots so that they could repay some of the loans. Again, that was inconsistent with what they had stated in other places. Thirdly, there were statements from a representative of an accountant for the taxpayer explaining why they had gone ahead and claimed some GST credits in relation to the property. This was on the basis that they were undertaking a subdivision that would be treated as an enterprise. And look, one of the practical things that we often see when it comes to clients and property transactions is, people are sometimes arguing that something is held purely for private purposes on capital account, but they've gone ahead and claimed GST credits, which kind of undoes that argument. And this is a good example of that. Why would you claim GST credits if you're not carrying on an enterprise? It's not really possible. So you've either made a mistake in claiming the GST credits, or there's another issue down the line in terms of whether this is an enterprise or not. So intention. We might have a stated intention from a client, but we really need to dig a bit deeper and find out, well, what evidence is there to either support that or go against that intention. The second thing that we just need to be a little bit careful about in cases like this is the flow on to the income tax treatment. Now, this case looked at the GST treatment. It didn't really kind of go into detail on the income tax side of things, but look, there is likely to be a flow on impact here, because if this is an enterprise transaction, it's probably going to be taxed on revenue account, which means loss of access to things like the CGT discount and potentially other concessions depending on the scenario. So might not have been an issue here in terms of main residence exemption, but you think of a slightly different scenario where there is a dwelling that maybe has been the client's main residence, being taxed on revenue account, potentially pushes you outside the scope of that exemption, and that could have a very significant and material tax impact. The third thing, which I kind of find interesting, and there's not an easy answer to this, is this is a taxpayer who it seemed might have had mixed intentions. And often we come across people who have a property and they're planning to do some development activities, but they don't seem to be entirely sure what they're going to do with the final development. I might sell it, depends on the market, I might keep it, might rent it out, maybe I'll live in it. That intention is sometimes a little bit grey and a little bit wishy-washy. Well, this case demonstrates that having that mixed intention where maybe it's not entirely clear what you're planning to do can actually work against you. In this case, the AAT accepted that the taxpayer may well have planned to live on the property at some point, so there may well have been a private purpose to holding this property. However, the AAT said that there was also an intention to exploit the property for commercial gain. And that meant that this could be treated as an enterprise, despite the fact that there might have been a private intention as well. So we just want to be a little bit careful, particularly with those clients who maybe aren't entirely sure what they're going to do with the property, maybe once it's been developed. There's a bit of a warning in this case in terms of the risk to those types of clients where they don't have that very clearly stated intention, which can also be backed up through objective evidence. So quite a few things, practical things that we can take from a decision like this, even though our clients' facts might be a little bit different.
The ATO have released a long-awaited draft determination on the deductibility of financial advice fees for individual. So Jason, does this mean that financial advice fees are deductible for our clients?
That's a really great question. The short answer to that is no. Late last year, the ATO released a draft determination, which is an update to TD 95/60. So for many years, we've relied on TD 95/60 when we're looking at deductibility of financial advice fees. The easiest way to explain the new draft determination is that parts of it are consistent with TD 9560, and there are some other parts which are newly introduced. So starting with what is consistent or largely unchanged, it's our deductions under section 8.1. So our deductions that are linked with deriving assessable income. So they would apply in situations where an investment portfolio is being reviewed, so an income producing portfolio being reviewed, or a income producing asset. So that type of expense will remain deductible under section 8.1. Also thinking about capital expenses as well. So the new determination reinforces the long-standing view that an SOA fee or a statement of advice fee for putting in place a portfolio will be capital in nature. So that expense is incurred before the assessable income is derived, so it's too soon to be a deduction, but that may be something that can be added to our cost base of a particular portfolio or a particular asset. The determination also confirms that expenses that are private or domestic in nature are not deductible. So that would include things like cash flow or budgeting advice. The new concepts in this determination are claiming a deduction under section 25.5. So most of us will be familiar with that, claiming our tax-related expenses, or our clients claiming our tax-related expenses. The determination extends that to allow certain financial advice fees to be deductible if that advice is provided by a tax financial advisor and that advice relates to tax or tax deductions and the like. So some examples in the determination include things like salary sacrifice. Advising on salary sacrifice wouldn't be deductible under section 8.1, but it is tax advice, so it could be deductible if that's provided by a tax financial advisor. Also thinking about insurance as well. So traditionally, we probably see personal risk insurance advice as something that has been non-deductible. So that would be seen as financial product advice. So financial product advice is still not deductible, but if part of that advice relates to tax, so perhaps that advisor has calculated some deductibility of the premiums, or perhaps they've considered the tax implications when insurance proceeds are paid out, they're the type of expenses that can be deductible under 25.5. So just to reiterate that, our standard deductions under 8.1 are still there when the advice relates to the generation of assessable income. We still need to consider whether some expenses are capital in nature, but we do have this additional deduction opportunity when it's tax financial advice provided by a tax financial advisor.
So coming out of this, is there anything different that financial advisors and licensees ought to be doing?
Financial advisors, advice licensees and tax advisors all have an important role to play to ensure that clients are able to maximise their deductions on their financial advice fees. The first thing to think about is, what is a tax financial advisor? A tax financial advisor is someone who is licensed to give certain tax advice as it relates to financial advice strategies. Licensees and advisors should look to include this on their invoices. So where an advisor is licensed to provide this advice, include that on the invoice so that the accountant is looking at that and they know to look for that 25.5 tax financial advice deduction. It's also important for financial advisors to break up those invoices and make things as clear as possible. If we go back to our personal risk insurance advice scenario, if the invoice just says personal risk advice, a tax advisor is likely going to look at that and think that's financial product advice, so that isn't deductible at all. Whereas if that is broken up into what is the product advice and also what is the tax advice. So the tax advice for a personal risk insurance statement of advice, that tax advice could include deductibility of the premiums. Has that been explored? What happens if a claim is made? Have we worked out the tax? Have we perhaps grossed up the sum insured to take into account the tax that might be paid on a total permanent disability event or even a death? So if those things are clearly broken up, then the tax advisor can look at that invoice and know that, yes, there's this portion that is tax deductible.
And from the ATO this month, we're looking at that distinction between a contractor and an employee. Mike, the latest material release from the ATO, what's important about it?
Yes, this is an area where we've seen quite a few developments recently, and they are important developments. And this is an area that a lot of us have had to revisit and really test our thinking and assumptions in terms of how we determine whether someone is an employee or contractor. And that's all thanks to the High Court. The High Court released a couple of pretty landmark decisions not too long ago, and from that point onwards we've seen the ATO, but also practitioners and clients trying to get their head around what that High Court decision means in practice. Now, a little while back, so after that High Court decision, or those couple of High Court decisions, the ATO released some draft materials and really reflecting the updated approach as stated by the High Court. And the ATO released two draft materials. The first was a draft tax ruling, and the second was a draft practical compliance guideline, which was really about explaining what the implications are of being an employee or a contractor, but also providing us with effectively a risk framework. So what, for example, you would need to do in practice to basically stay under the ATO's radar when it comes to classifying someone as an employee or a contractor. Now, those draft materials have now been finalised, and this is the material that was released not long before Christmas. So we now have a final tax ruling and a final practical compliance guideline. The ruling is, I guess, the technical piece. It really works through how do you determine whether someone is an employee at common law, so under general law principles. It doesn't go into things like how do you know whether someone is an expanded employee under the definition for super guarantee purposes. So you can't necessarily just read this ruling and stop there. It will help you get a fair way down the track. But for example, if you're dealing with the super guarantee system, you need to look beyond just that ruling because there are other concepts. There are other people who are deemed to be an employee, even if they're not a common law employee. Now, one of the things in the final ruling that is a little bit different to what we saw in the draft ruling is around, I guess, what I refer to as what's contained in the contract, if there is one. So when the High Court looked at this issue, they basically said that rather than looking at the conduct of the parties, you look at the written agreement. What are the terms and conditions that are contained in the written agreement or contract between the worker and the business? And so if the parties have committed the terms of the relationship to a written agreement, you look at that and that's how you determine whether someone is an employee or not, rather than looking at how they conduct themselves. Now, the problem is, and it might be a pretty obvious question, is, well, what do you do if there is no comprehensive written agreement? And this is one of the things that's been clarified in the final ruling. The ATO says, well, if there is no written agreement, you need to look at the conduct of the parties. So if there is a written agreement, you won't really be focusing on the way the parties conduct themselves. However, if there is no written agreement, you basically are forced to look at the conduct of the parties to try and figure out whether this person is an employee or not. Now, in practice, obviously your job will probably be a fair bit easier if there is a written agreement and it's comprehensive and it explains exactly how the parties would deal with each other. That will normally make your life much easier, and you'll often find that the risk of challenge or dispute when it comes to the ATO will be lower if there is a nice, comprehensive, formal written agreement between the parties. That will certainly make your job easier. So that is one of the things that we've seen that is updated from the previous version of the ruling. The other thing I'll just point out very quickly is when we're talking about the contract and what's contained in the contract, we're talking about the terms and conditions, the substance of the agreement. Don't pay too much attention to the label that is given to someone. So an agreement might refer to someone as a contractor, but the terms and conditions are consistent with employment. Well, that person is probably an employee, despite the fact they're labelled as a contractor. So be very careful when we talk about a contractor, terms and conditions rather than labels.
So what should we be taking away from this guidance? What are the practical aspects?
Well, firstly, one of the issues that is discussed very briefly, unfortunately, in the ruling is what happens when someone is working through an interposed entity that they control. So someone might be, I guess, contracting or engaged by a business, not personally, but through a company or a trust. Now, this is an area that can cause all sorts of problems and it raises some pretty big question marks. What the ATO is basically trying to say, it looks like, is if someone is genuinely engaged through their company or trust, so it's the company or the trust that has the contract or the agreement with the business, then the individual who might kind of perform some of the work shouldn't be an employee of the business. So That seems to make things nice and clear that you might be able to avoid that employee relationship by working and contracting through a company or trust. I'm not sure it's quite that simple though. First of all, the ATO points out that, look, you do need to look at this pretty carefully, because if it appears that the employee is personally engaged to do the work, they could still potentially be an employee. And that would presumably be the case even if invoices are issued by the company or the trust. So I still think you need to be quite careful about that. The other thing that has always just concerned me a little bit is there have been cases over the years where workers have appeared to be engaged through companies or trusts, and where the courts have found them to be an employee. And those are not necessarily tax cases, they're cases that have kind of looked at other areas, for example, employment law. It does seem that it can be just a little bit risky to assume that just because it looks like someone's working through a company or trust that they couldn't be an employee. I think you just need to be a little bit careful about that still. And the ATO's comments, as I say, in the ruling are very brief, and they don't necessarily going to give you a 100% black and white answer in every case. You still need to look at the arrangement. Now, the other thing we need to look at is this final PCG that's been released, where it sets out the risk zone. So how do we figure out the risk of ATO review or challenge when we've classified someone in a certain way? For example, if we genuinely think someone is a contractor, what's the risk of the ATO accepting that and not kind of digging deeper and trying to challenge that? Well, the ATO sets out a number of different risk zones. I think a lot of people would like to be in the very low risk zone, but to do that, you do need to pass certain conditions. For example, you need to ensure that there is a comprehensive agreement between the parties. You need to ensure that it very clearly states how this person is being classified, employee or contractor, and you need to show that the parties both understand the implications of that. You need to show that the business has obtained advice around that treatment. And what the final PCG goes to say is a little bit beyond what was in the draft version, which is that advice needs to be reasonably arguable. So just getting some advice that someone is a contractor, well, it needs to be from a recognised tax practitioner, but it also needs to be a reasonably arguable position. And again, there's a question of fact whether you've kind of reached that standard or not. You need to make sure that the conduct of the parties hasn't significantly deviated from what's in the agreement, and you need to ensure that the parties are actually, I guess in practice, approaching things consistent with the classification that's been reached. So I guess, look, the good thing is that if you do want to be classified as very low risk, the ATO has set out a series of steps that you can follow to get to that point, which means that you will have probably a pretty good level of comfort when it comes to possible ATO challenge. But they are some serious steps that you need to take to get to that point. And look, you would imagine that particularly smaller businesses might find that that process is still a little bit maybe costly or a bit complex to work through. And I'm sure that in many cases you're going to come across situations where those conditions simply aren't met, which means that that risk level will still be that little bit higher. So the PCG, it is useful to try and discover what is it you need to do to get to a very low or low risk position, if indeed that's what you or your client are after. But beware, you need to pay attention to the detail. It's quite a high standard that you need to meet. So some very strict conditions that need to be satisfied if you want to get to that very low risk position.
And that's the roundup for this month. To help you and your team keep up on top of change and make sure that you're protecting your practice against risk and delivering the right advice, let us show you how the Knowledge Shop membership can make a difference to your firm, whether you're an accountant or financial advisor. Give the team a call or drop onto the website. We'd love to show you how we make a difference for thousands of accounting firms and financial advisors every single day across Australia.